this session, we discussed how to break the cost into fixed and variable, and then did few workings like a break-even point, margin of safety and other things. We will do a real life case study on how to split the cost into fixed and variable. This company is called Power Pack Batteries. The case details are: the Power Pack manufactured dry cells and related products. Sales was stable for the last few years. Profit was showing variation and has come down sharply last year. For the first time, the company posted a loss of in the December 2015 quarter. We have some data. The table 1 gives the profit and loss account for the year for the last 10 years. Table 2 gives you quarterly results of 2015 December, where the company reported a loss, and compare this with December 2014 data. Table 3 gives a competitor financial data. We have few case questions. The first one is that why the profit of Power Pack battery shows high volatility though sales are stable. What is the current break-even sales? Examine the risk of the business using margin of safety, degree of operating leverage and CVP index. Can you provide some additional insight on the competitor cost structure? You are required to draw as much inferences as possible using the competitor data and create a cost structure of the competitor firm. Then finally, advise the Power Pack for the long term strategy. Now, let us move into our working. So, we have first the data, the table 1, we have a 10 years data available, 2005 to 2014 the data is available. Our first question is that why the company is having profit is a variation. For example, if you look into that, the standard deviation of the sales net of excise duty divided by average sales, we call this as a coefficient of variation. It is a 0.07. If we do the same thing on the profit, it is a 0.51. If the value of coefficient of variation is high, it means the volatility is very high. It is a per unit of average, what is the standard deviation we are getting. So, the question is that why it is happening like that one. One way for us to get into that is which particular cost element is causing this kind of a problem. So, what we will do that, we will first copy this one in a new sheet to answer the first question. Let us relabel this as a data, question 1. Okay. Let us put this number raw material cost as a percentage of sales net of excise duty. Let us lock the row 4. No, row 4 should be floated. It is locked. So, what we have done is that we have computed what is the raw material cost as a percentage of sales for every year, like that for every other cost we have done. The next one is that interest was as a percentage of sales. So, if you look into that, there are two cost elements which are very high compared to other costs, raw material costs, and to some extent the employee cost is a relatively high. Of course, selling and distribution administrative cost is also high. If you look into that, the raw material cost, it was 71% in the first year at the beginning of the 2005, then it was come down to 66%, it moved up, then suddenly increased to 77, 76, 79, and then suddenly it dropped to 68% and 63%. So, by doing the same analysis of this coefficient of variation on the raw material cost, you can see it is a 12% or 12 value, and then when it comes to the miscellaneous, anyway the number miscellaneous is very small. So, it is a 12.12 as a coefficient of variation is a cost. To answer this particular question, why the profit is volatile when you have a very stable sales data, the cost data are volatile, particularly the material cost. If I just do the graph of this material cost, you can easily see how volatile these numbers are. So, this is how the numbers, it is fluctuating from year on that one. So, what does it mean? It means that the company is not able to pass the raw material price changes to the customer. If the company was able to successfully pass this amount, any increase in this thing, then the numbers would be very stable. Percentage of raw material cost as a percentage of sales would be very stable. Just to give an example, suppose in this particular year, when the raw material cost increased from 71% to 74%, 77%, if the company increases the selling price, then it will continue to be at 71%. It will not increase to 77%. So, when the prices have gone up, but the raw material prices have gone up, but it is not reflected in the selling price, then we will have an increase in the raw material cost. Similarly, you can see the employee cost is stable, but on the recent year it has gone up, and then selling and administrative cost is also stable, but it has gone up recently from around 9-10% to it is now 12%. So, there is a pressure on the cost. The companies which could be probably because of the competitive forces preventing the company to increase the prices. Now, the second question is analyze the cost structure and find the break even point and other things. We will do that one. We will copy the data. So, we have an Excel function called intercept and slope to compute these values. So, variable cost, and then we have a fixed cost. So, first let us try anyway for the raw material there is no fixed cost, therefore, we will use not a slope function, we will use a line estimation function. Line estimation is used whenever we say there is no fixed cost or fixed cost is a 0, then we use a line estimation on the assumption that the fixed cost is equal to 0. The system assumes the fixed cost is 0 and gives you the value. We have to put a 0 after that. So, 72% of the cost is a raw material cost is a fixed cost. 72% of the sales is a raw material cost, is a variable component. Earlier also we saw it was around 72%. Raw material cost is around 70. In the recent year it has come down, but otherwise on average when you look into that it is a 72%. We will now do for the power and fuel cost, that is we will use the slope function. If the slope function gives you a negative number, then we will use the line estimation function. It is 3% of the total sales is the power and fuel. Then the other one is the intercept. Sales. It is a negative. So, the cost cannot be negative, therefore, we need to use a line estimation function. We will do that later. We will first complete for the all cost element, and then we will do them together all line estimation. Wherever the numbers are negative, we will do the line estimation. What we have done is we have just locked the sales value, so that we can drag the formula for other things. We have to rely on the line estimation function, because in one of these cases we get a negative number, and therefore, we have to follow the line estimation function. So, let me just remove them. So, all costs are variable in nature, and then we have a depreciation. The depreciation is a fixed cost. The latest year is what we consider as a fixed cost on that one. Then let us sum it up, the total cost. (94.8% is the variable cost and 8.33 is the fixed cost. $8.33 is a fixed cost. With this data, it is possible for us to find out what is the break-even point, margin of safety, and many other things. So, the break-even, first thing is the break-even point. For that, we need to find out what is the contribution margin. Sales contribution margin is equal to 1 minus variable cost is a contribution margin, that is a 5.2%. Our fixed cost is 8.33. Therefore, the break-even point in rupee sales is equal to fixed cost divided by contribution margin, that is 159.64 is the break-even point. So, the break-even point is a pretty low, and current sales, the company is operating at 510 is the current sales, break-even point is 159, margin of safety is equal to the difference of these two values. 351.22 is the margin of safety. Sales divided by BEP sales, how far we are away from the break-even point sales. Current sales divided by break-even point sales is 3.2 times we are away, and CVP index is equal to contribution margin multiplied by sales divided by break-even point. The first term, the contribution margin, gives you the profitability of the business. The second term gives you the risk associated with the business. Larger the sales compared to the break-even point, the risk is relatively lower, and together we get 0.16 as a CVP index, which is a pretty decent. But the trouble now is the company is posted a loss in the recent year. 21.8 is a loss, right, because December, what we have analyzed is till March 2014 data is what we analyze. But 2015 happened to be a different year. Suddenly the company sales have declined to 42 for the quarter. At 42 for the quarter, it is not going to be anywhere near to 510, right. 42 multiplied by 4 times, it is going to be only 160 or something like that is the value we are going to get, which means that our break-even point is a 159 and our sales will be closer to that number. So, therefore, the company is likely to post a loss value on that one. Now, therefore, the question before us is that, is it possible for us to get the competitor cost data and analyze that one? Unfortunately, we could not get much of the competitor data. We have only two numbers, that is the sales and profit value for the 3 years. Sales for the first year and second year are 400, 500. The profit for the first and second year are 300 and 550. When it comes to the third year, sales continue to increase for the competitor and the profit have declined to 32. Let us try to build the competitor cost structure using the year 1 and year 2 data. So, let us copy this. This is question 3. Okay. Now, when we have the two data, it is possible for us to find out what is happening on the overall cost structure. Since a company is posting a profit in all 3 years, we assume that the company is operating above the break even point. Only above the break even point operation we are going to report a profit. The company is reporting a profit in all 3 years. If the company is operating above break even point, then the differences in the profit divided by differences in the sales is equal to the contribution margin. Because once we cross the break even point, the entire contribution goes to the profit. Therefore, when the company is moving from 30 to 50 profit, the contribution also moves by 20 rupees or 20 million US dollar in this particular case. So, contribution margin for the competitor is equal to the differences in the profit divided by differences in the cost, the difference in the sales value. So, we have a 20% profit margin, contribution margin. Once we have the 20% contribution margin, variable cost is equal to 1 minus contribution margin. In the previous example, we have used 1 minus variable cost as a contribution margin. The same thing holds good here. 1 minus contribution margin is a variable cost. Now, let us apply to any one of the years. Let us apply to year 2. Sales 500, variable cost 80% of that is a variable cost, contribution is equal to 500 minus 400 is equal to 100, less fixed cost, that is unknown for us, and that gives us a profit. And profit value we know it is equal to 50, and therefore, this should be equal to 50. So, with this two data points, we are able to create a cost structure on that one. We can check whether it holds good for the year 1. It should be it's the same 400, 80% of 400. The difference is 80. Our profit is a 30, and therefore, the fixed cost is a 50. 80 minus 30 is a 50. Now, coming back to year 3, we have a sales of 800 and 80% of that is a 640, is a 160 less 50. The company should have reported a profit of 110 in year 3. This should have been the profit for the company. So, this is a year 1, year 2, year 3 expected. But what has happened, actual profits are different. Actual profit is 32, which means that it is 82, 640. So, the company is actually selling at 800 multiplied by 80%, is the variable cost 722. So, the company is, instead of selling at, if the company sold at 800, then it would have reported 110 as a profit. By selling at a price lower than that, they are realizing a profit of 32. Working backward, the company is giving or dumping the product at by reducing by 78 in the market. The 78 is also equal to the difference of these two numbers. 110 should have been a profit, but actual profit is 32. The difference is 78 is a profit. So, it is a very clear case that the competitor is now dumping the product and then discounting the price at how much? 78 and 80 is roughly 10%, close to 10% they are discounting and selling the product. So, the competitor pricing is an aggressive pricing is a root cause for the company's sudden decline in the profitability from profit to in the last year December they reported a profit of 65 crore, suddenly it is a negative loss of 21 crore and they had a volume of a sales realization of 140, now it is just 42. Their products are not moving in the market because of this aggressive pricing of the products in the market. Let us now compare how this company is related, the cost structure of this company compared to the other company. So, we have the cost structure of this company where the contribution margin was at 20%, competitor cost margin, contribution margin is at 20%, variable cost is 80%. In question number 2, we worked out the contribution margin. So, we have a 5.2% power pack competitor. Power pack contribution margin is a 5.2%, whereas a competitor is getting a 20% contribution margin, which means they were able to control the variable cost at a very high level, whereas this our company, the power pack, is having a very high variable cost. Then the fixed cost is a 50, whereas the fixed cost for our company is a 8.33. Variable cost is 1 minus this, which is equal to 94.78%. So, one possible reason is that power pack is more of a labor intensive, whereas the competitor, overseas competitor, you would have automated the plant at a very high level, so that the variable cost has come down drastically to 80% compared to 94%. Because of this high automation, the fixed cost is very high, but the productivity of the assets are very high. They were able to produce a larger quantity and at the lower cost, and that is the reason their ability to penetrate the market from 500 million sales, they moved to 800 million. So, there is a huge jump from 400 to 500, which is about 25%. From 500 to 800 is about 60% jump in the volume they were able to achieve, which is primarily because of the high level of automation that brought down the fixed cost drastically, and then that increases the fixed cost, but brought down the variable cost drastically. So, one suggestion for this, the question number 4 is that what should be the long term strategy for this power pack? The power pack should now start looking into automation as a way and then bring down the variable cost and then increase the contribution margin from 5.22 to a higher level. At 5.22, it is not sustainable, particularly to withstand the competitor. So, how to increase this one? The one way is that automation. The automation will bring down the cost to drastically, but of course, automation will also increase the fixed cost, but with a good volume, it is possible for the company to meet the challenges imposed by the competitor. So, that way this particular the data, even though the data is a very few on the sales and profit data we have, it is still possible for us to build the cost structure and analyze the cost structure for the benefit of this power pack company to then develop a long term strategy.